Investment option 1, pay down your debt. This one has the lowest risk because if you pay down your student loans or your credit card debt or your car loan or your mortgage 1 year early, you get a guaranteed return on your money. Let's assume that you have $8,000 worth of credit card debt, which is actually less than the average household credit card debt level in America today, and your credit card is charging you 25% APR. Now, the first thing you have to understand is if you take your extra money and use it to pay your debt down, you get a guaranteed return, because if you pay off your credit card debt 1 year early, that is a guaranteed 25% return, which will beat pretty much every other investment out there. In fact, let me show you the power of this. Let's assume that you never swipe your credit card again. You have $8,000 worth of credit card debt, and then you only make the minimum monthly payment of $200 a month. Now, it's gonna take you about 7 years to pay back this credit card debt, and then you're gonna end up paying $9,379 in interest. Not in total payments, but in interest on this $8,000 worth of credit card debt, which means you're going to pay more money in interest than you will to actually pay back the principal balance on your credit card. Option number 2, keep the $100 in cash. This is another very low risk opportunity, because you know that if you deposit $100 in your bank account today, if you open up your mobile banking tomorrow, you're gonna see that $100. And at the time of me recording this video, if you open up a high yield savings account or a certificate of deposit, CD, you can get somewhere around a 4% return on your money, which isn't the best, but that money is sitting there and you don't really have much risk besides the risk that your bank could collapse or inflation. I'll talk more about inflation later. This means you don't have to worry about losing money per se, and you know that after 1 year, you should have around $104 in your bank account. Not the best return, but it's better than you taking this $100 and spending it on an avocado stuffed animal. The third way you can invest $100 is to put this money into a tax-deferred retirement account, something like a 401k or an IRA or a 403b. When most people think about investing, this is what they're thinking about, because your 401k or IRA is the most accessible place to start investing, and this is where most people start investing, but this is just the beginning, and there are 5 things that I need you to understand about this. Number 1, the advantage of a 401k is if you can get a company match. A company match is where some companies will give you some free money essentially if you invest your money into a 401k. So if you invest $100 into your 401k, a company might say, we'll give you a 50% match, meaning $50. Maybe we'll give you a 100% match, $100, just depending on what your company offers. But this is going to vary company to company. The second thing you want to understand about a 401k or an IRA is that you are now locked in. You generally cannot pull your money out without paying a penalty until you are at least 59 and a half years old. Can you access your money? Sure, but you're going to pay penalties and fees if you tap into your 401k or IRA before you turn 59 and a half years old. Number 3, you have to understand the tax benefits or non-benefits of a 401k and IRA. There are 2 types of accounts. You have Roth and traditional accounts. This applies for IRAs and 401ks. A traditional is where you make money and then this money goes directly into your account. So you make $100 and then this $100 goes into your 401k or IRA pre-tax. So all $100 that you make goes into the account. Then this money can go tax-free. And then when you turn 60 years old, you can start to pull this money out. But then you're going to pay taxes when you're 60, 65, 70, and you start pulling this money out of your 401k or IRA. Then you're going to pay taxes at whatever your tax rate is when you are retiring. Now, what some people like to say is, when I'm 70 years old, I'm not going to have an income, so my tax rate should be lower. My concern is, number 1, my goal is to increase my income every single year through my investments, so I'm hoping that I have more income when I'm older. And number 2, I have no idea what the tax rates are going to look like when I'm 60 or 70 years old. I know that the government has a lot of debt, and I know that there's a big chance that the government could be raising taxes in the future. So when you take a traditional 401k or IRA, just know that you're going to pay taxes when you pull the money out, and we don't know what that tax rate is going to look like. With a Roth, what that means is you're paying taxes on that money today. So if you made $100, you're going to pay taxes on that $100 today. And so maybe you're left with $80 after paying taxes, and then this $80 goes into your Roth 401k or IRA, and then this money can grow generally tax-free, and then whatever money you have in this account when you're 60, 65, 70 years old, you can pull out tax-free because you pay the taxes when the money goes in. So with a Roth, you pay taxes when the money goes in. With a traditional, you pay taxes when the money comes out. Fourth, you have to think about fees, because when you put your money generally into a 401k, your money is going to go into some sort of mutual fund, generally. And these mutual funds, even if it's an index fund or ETF, all these funds have a fee. It's called an expense ratio. So if you didn't know that your 401k is costing you money, your homework after this video is to go out and look at what your expense ratio is. The average expense ratio on an actively managed 401k fund, meaning a mutual fund and a 401k, is 1%. Now that might not sound like a lot of money, but you have to remember, this is a 1% fee on every dollar that is invested in your 401k for every year that your money is invested, including every dollar of profit that you earn. So this 1% fee is compounding along with your potential growth, and this 1% fee can add up to a little over 25% of your total investment value over the life of your investments. So if you were thinking you would have $1 million excluding fees, after fees, you would have a little bit under $750,000 left in your account because you had to pay this 1% fee. And then number 5, you have to think about options. Because when you invest in a 401k or IRA, you generally have limited options on where you can invest. Now, yes, you have more options with an IRA. IRAs have a little bit more flexibility. They give you some options to invest in real estate. There are options to do that with an IRA. With a 401k, you're very limited on where you can invest your money. This is why one of the things that I like to say is when you're investing your money, your 401k and IRA is just the beginning. This is not the end of your investments. This is just the beginning of where you start your investments. And now I can't recommend what I do to anybody else because my investing journey is unique and different, and so is yours. But for me, I don't use a 401k or IRA because I know that I can get better tax advantages by investing my money into things like real estate and into things outside of the 401k and IRA. So I don't use these because they just don't make sense for me. Now, they're a great place to start, but this is where I want you to continue investing in your financial knowledge and financial education, that we can find the best investments, that we can get the best returns for yourself. And before we move on to number 4, I want to remind you that my team at Briefs Media publishes a free daily newsletter called Market Briefs, where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy-to-read newsletter. We have hundreds of thousands of investors that read it every single morning. So if you have not joined Market Briefs yet, well, I got the link for you to join for free down in the description below. The 4th way that you can invest that $100 is by putting this money into the stock market. Now, this is outside of your 401k or IRA. This is now you creating your own stock brokerage account. There are so many brokerages out there. You can check out my links down in the description if you want some help finding some. But now you're going to find a stock brokerage, and now your goal is to grow your money through the stock market. And there are 2 ways that you can invest your money in the stock market. I like to call this a passive method and an active method. Passive is where you're just going to throw your money into the markets. So there are funds, ETFs, mutual funds, index funds. What this means is these are baskets of companies, these are groups of companies. So instead of investing in, say, the Amazon stock, you're investing in a group of maybe 500 of the largest companies in the stock market, and Amazon is one of them. This way now you don't have to worry about analyzing the perfect company and picking the perfect stock. You're just going to throw your money into a fund. This is what I call passive investing, and the way that you succeed as a passive investor is you got to CPA. You got to be consistent, you got to be passive, and you got to be automatic with this. What this means is you want to pick a cadence, whether it's every week or every 2 weeks or every month. And then we just put your money into these funds and you let the markets do their thing. So I do this and I do this. For me, my CPA strategy is every Wednesday. I picked Wednesday because it's in the middle of the week. There's no science to this. But every Wednesday, money is pulled out of my checkings account and is automatically invested into my portfolio of funds. Now, I have funds that give me exposure to a lot of different things, some to the general stock market, some to dividends, and some to a little bit more innovation. But this is where my money is being automatically invested. And you just got to figure out what types of funds you want to invest in, because there are funds for pretty much everything. For example, there is an ETF, and I'm not telling you what to invest in. I got to remind you as well, investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. There's an ETF out there called VTI. This is created by an institution called Vanguard, and this gives you exposure to the total stock market. So if you just want to buy the American stock market, VTI gives you exposure to the total stock market. Another example, SPY. This is an ETF that gives you exposure to the S&P 500, which is a group of the 500 largest companies in the stock market. So if you just want to invest in the 500 largest companies in America that are trading on the stock market, SPY. You can create a system that invests into this, and what we've seen is that over the long term, markets go up, markets go down, market crashes happen, recessions happen, market booms happen, but over the long term, markets have generally gone up And this is where you just got a CPA through the ups, the downs, and the sideways consistently, even through the tough times, and that's where the wealth is built. Active investing is a little bit different. This is where you're gonna put aside some money, and then you're gonna actively find a good investment. Now, when I say active, I don't mean trading, I mean looking for a good investment. This would be now you're looking for either a fund or a stock to invest in that's a little bit more niche. Maybe you're looking for a new market shift, you're looking for an opportunity, you're looking for something to invest in, but now you gotta study the financials. You gotta do the research, and you gotta put in the time to make sure that this is the investment that you wanna be involved in, but it's not automatic. You have to go and deploy this money if you see a good opportunity. Again, you don't have to pick one. I do both of these, but you got to find the right strategy for you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.